Hello, and welcome to a brief overview of 8 different strategies to pay for long-term care. My name is Wesley Walters. I'm the founder and CEO of Asset Preservation Solutions, and my company does exactly what we say. We try to help people not lose money in several different areas of their life, but long-term care is obviously something that can drain people. My company is 17 years old, and we're committed to helping people understand the choices that they have financially, both before and during retirement. I'm a member of the Council of Financial Educators. We are committed to help get good information to people. We believe that with enough information and accurate information, consumers can make better decisions and they can make them on their own. So let's take a look at the basics here. What is long-term care? Well, many of you probably had family members that have needed long-term care. And this comes about because a person needs activity assistance. There's 6 different activities of daily living, as you see on the screen. And when a person needs 2 of these, then a long-term care policy or strategy can come into play to help reimburse the people for their losses. The other is cognitive needs. So one of the things about long-term care is it has a very high potential that we'll have to use it at some point in time. And when I say use it, that could be a week in your living room, or it could be 6 years in a nursing home. It doesn't matter. There are 70% chance that people over 65 at some point in their life is going to need long-term care. And we compare that to our other risk that we face on a regular basis. A major car accident is only 1 in 340, and loss of a major event in a house fire is only 1 in 1,200. So the long-term care is much, much, much more probable going to happen. Why don't we insure against this like we do our house and our car? Well, a couple of reasons. Number one, long-term care is pretty complicated. And number two, it's a whole lot more expensive than property and casualty insurance. So when would you need long-term care? As I mentioned, anytime there are a need for 2 out of the 6 physical activities of daily living, that's a long-term care event. And if you need assistance due to cognitive issues, that's also a long-term care event. That's the 2 main reasons why people need long-term care. So where can long-term care take place? Virtually about anywhere. You can receive care in your home, which is obviously the choice that most people would like to have as long as possible. They can be community services like adult daycare, supportive programs. Assisted living is very popular and costs much, much less than long-term care. A nursing home is where the people don't want to be, but unfortunately they're pretty full, so people have to end up there. And memory care units are usually priced between assisted living and long-term care in a nursing home. As I mentioned, this is pretty expensive stuff. So this is our cost pretty much in our state of North Carolina. So you'll see that homemaker services and assisted living are very similar in cost. Homemaker services, usually there needs to be a spouse in the house or another live-in person because a person that needs outside care on a long-term basis, more than 10 hours a day, is probably better served going to assisted living. People want to be in their homes, but sometimes they're just not capable of staying there. When we look at nursing home, this is where the real event occurs that can devastate finances. So in a semi-private room, you're looking around $85,000. In a private room, around $92,000. So 3 or 4 years of that can wreak havoc on a financial plan. So how do we pay for this? Let's take a look at all different ways that I can tell you to pay. I put self-pay first because only about 15% of eligible people are insured. So most people by far and away are looking at self-funding this. I always used to tell people, if you're looking at self-pay, make that a proactive decision. Look at your other choices, and if you feel self-pay is the best for you, then that is the best for you. Make the decision, stop looking around, act or don't act. Either is fine. The traditional long-term care policy, and I call this traditional because that was the first way that people had a way of moving that risk to an insurance company. The first policy was written in 1965, and they've gotten much, much, much better over time, but that's when they first started. There are two bad raps about traditional policies. Number one is the premium is not fixed. It will go up. It will go up probably several times if you own a policy for 20 to 35 years. The second is they are use it or lose it policies. In other words, you buy this when you're 60, it costs $3,000 a year. You die when you're 90, you never used it, so you spent $90,000 on something that you never are going to reap the benefit. I think that's a good thing. I don't want to go to a nursing home and use my insurance. I don't want to use my car insurance or my home insurance. But due to the cost of long-term care, that can be pretty discouraging for people to spend that much money and never receive anything back. There is also something called a partnership plan in most states. And I won't go into great detail about a partnership plan, but I will say this. Three things. This is a use it or lose it plan, just like traditional. Your premiums are going to go up just like traditional. But the big difference is that partnership plans offer additional asset protection than just being reimbursed by your policy. If you would like more information about that, contact me. It's a reasonable alternative to the other items you're going to see. So now, years ago, they came out with what we call hybrid policies. And what that is a whole life insurance product, but it's also designed to be a long-term care product. So all long-term care products have a few things that you select. How much will this pay me a day? How long will it pay me per day? Is there inflation protection in there? And there's a waiting period before your plan starts to pay. The hybrids are just the same. They have the design factors that all long-term care policies have. The good thing about this is it beats those two drawback items of a traditional. Number one, there is no increase in any cost once you have the policy. Number two, if you don't use all of the benefits or none of the benefits, the beneficiary is going to receive a tax-free death benefit when a person passes away. Now, if you use up all the benefits, the policy has done its job. But if you don't, this solves that problem of use it or lose it. Then traditional structured life insurance policies started to design in the fact that, people might need this death benefit before they pass away. So there is an option for long-term care. It is not a design feature. What you'll typically see is the policy will pay out 2% per month of the death benefit. So if you have a $400,000 death benefit, that can pay out up to $8,000 a month for long-term care. The premium should not go up. And same thing, if you don't use all your benefits, somebody's going to receive a tax-free lump sum death benefit from the policyholder. There are annuities that offer a doubling of the annuity income if you are in long-term care. So if the annuity is purchased and not used until long-term care, you might see a policy that'll pay $4,000, $5,000, $6,000, $7,000 a month. And they'll do that for up to 5 years, and then they'll resort back to the previous payment. So one strategy for this is plan on that being your long-term care, devote dollars to that. There is no premium that's going to increase, and there's a residual death benefit if you don't use up all the cash. One thing to be careful of with these is you have to know where they will pay the benefit. Not all of them will pay if you're getting home care. Some of them are strictly going to pay if you're in a nursing home. So at the very minimum, you want to be sure one will pay if you're in assisted living or a nursing home. So that increases the income. This annuity deposit increases your overall value of your long-term care strategy. So for instance, if you put $100,000 into this particular annuity, depending upon your health, the real value that it brings could be $200,000 on a double and $300,000 on a triple. Now the drawback to this, there are no premiums. If you don't use it, you're going to get your money back. And if you don't use all of your money, your inheritance will go to someone. But the first money out of pocket is going to be the $100,000 deposit you made before you start to realize the doubling or the tripling effect of your lump sum. Finally, this strategy is not paying for long-term care. This strategy is setting you up to receive government assistance for long-term care. Of all the things on this page, this one is the least costly, but you are getting an irrevocable trust, meaning that you're going to divest yourself of your assets and put them into an irrevocable trust. So that if you need care and you go for government assistance, it'll show that you don't have much assets at all. You don't put everything in here, but you do try to feed a lot of your financial assets as well as real estate assets. It does offer very good protection, not just for long-term care, but for other purposes as well. The key is you have got to get a good trustee that will give you the funds you need when you need them. The main thing about an irrevocable trust is people are concerned about losing control of their assets. That's something that worth talking about. Please contact me for further conversation. So if you want to see how some of these solutions might work for you, go to our website as you see on the screen and schedule a time to talk to me or send me an email. I'll be glad to cover all of your options with you, no cost or obligation. It starts out to be educational. If you want to take action, that is totally up to you. I hope this has been beneficial. It covers all the different ways to pay for long-term care. And again, if you would like further information, please give me a call.